Before we start this video, do like and subscribe to our channel and not miss on any updates.
Now what we'll do is we'll take up each component of the cash flow statement and understand that in detail. We'll begin with cash and cash equivalents and then move to other sections. Now when I ask you what are cash and cash equivalents, you would say, sir, cash part is very simple. Whatever is the money we have, whatever physical cash we have, whatever the currencies we have, that is what we call as cash. That is what we refer to as cash balance. This is our general understanding. In general sense, whatever is the physical currency, that we refer to as cash. Let's say I've deposited some money into the bank, then I'll call it my bank balance. But for the purpose of AS3, we have to unlearn this concept and understand cash in a different way. For the purpose of AS3, cash includes cash in hand and demand deposits with bank, which means whatever physical currencies you have, whatever the balances you have with you, that is definitely cash. But apart from that, whatever money you have kept with the bank in demand deposits, that also forms part of your cash. Now what is this demand deposit? To put it very simply, demand deposit is a deposit which has to be repaid to you on demand. For example, you deposit 10,000 rupees in your savings account today. Okay, so you have opened a savings account where you have deposited 10,000. Tomorrow when you go to the bank and ask the money back, the bank will have to pay you back. The bank can't say that I will not pay you, because the amount is repayable on demand. Whose demand? The demand of the depositor. So when you as a depositor deposit money into your current account or in your saving account, that is a demand deposit, because that has to be paid to you when you demand that. Such deposits which are repayable on demand are called demand deposits. So then what are the other kinds of deposits? There is something called a time deposit. When something is called a time deposit, it will be repaid only after a fixed period of time. Say for example, when you go to a bank and you open a fixed deposit for, let's say, 1 year, the bank will not pay you whenever you demand it. The bank will pay you only after 1 year. Now sometimes what may happen is you may ask the bank to shorten the duration and close the deposit in advance and pay the money back to you. The bank may pay the money back to you, but when it pays back the money, it will charge some penalty from you. But when you ask the bank to give your savings account money or current account money, it will not charge any penalty. But if you open a fixed deposit for 1 year and you want the bank to pay you back in 7 days, the bank will definitely charge some penalty. So that is the difference between demand and time deposit. Demand deposits are repayable on demand. Time deposits are repayable after a fixed period of time, right? So what does cash include? Cash includes cash in hand and demand deposits with bank. Now we have understood the meaning of cash. What is cash? Cash on hand plus demand deposits with bank. Now we will understand what is the meaning of cash equivalent. Now what is this cash equivalent? Cash equivalent is something which is very close to being cash, but it is not cash. Say for example, you went to a bank, you opened a fixed deposit, you kept your money for 15 days. So you have opened a fixed deposit for 15 days only, and you have agreed with the bank a specific rate of interest. Now if I have to ask you, do you know the amount that you will get after 15 days? The answer to that is yes, because you know the principal, you know the rate of interest, you know the duration. So you will know after 15 days what is the amount that you will get, right? Now when you know what is the amount will you receive after 15 days, now if I have to ask you, how much confident are you that you will receive the same amount that you have computed? You will say, sir, I am 100% sure that I will receive that specific amount. Why is that so? Because you know that there is very remote chance that bank will pay you something else, or the bank will close down and you will not get the money. The chances of that are remote. They are very insignificant. So such investments which are short term in nature, which are highly liquid, which can be converted into known amount of cash. So today you know that this investment will fetch a specific amount of cash after a certain period, and there is an insignificant risk that the value of that investment will change. Means let's say you have estimated that you will receive 1010 rupees after 15 days. There is a very less chance, there is an insignificant risk that that 1010 will become something else. Such kind of investments are classified as cash equivalents. So what are the 4 things you have to check? Short term, highly liquid. Highly liquid means you must be easily able to convert that into cash. Something like if you invest in land, is land a liquid investment? No, land is not a liquid investment because you will not be able to convert a piece of land into cash very easily, right? So that is a illiquid investment. So you have to consider short-term liquid investments which can be converted into known amount of cash, meaning to say you must be 100% sure or you must be 99.99% sure of the amount you will get when you convert that investment. Now let's say you have invested in shares. You want to sell them off in 7 days. Are they liquid? Yes, shares are liquid. But do you know what is the amount you will get after 7 days? The answer to that is no. If you are selling equity shares in the market, you will not know after 7 days what is the amount you will get back. So shares cannot be classified as cash equivalents. On the other hand, let's say you had purchased preference shares. Which are maturing in, let's say, 15 days or 30 days time. Now in case of preference shares, you are almost sure of the amount you will be getting. So that can be classified as cash equivalent. But also when you are classifying preference shares as cash equivalent, you must see the 4th factor. What is the risk of changes in value? If the risk is insignificant, then you may classify it as cash equivalent. But if the risk is significant, you are unsure as to what is the amount you will get, then in that case, you will not classify it as cash equivalent. So we have understood what is cash, what are cash equivalents. Cash comprises of cash on hand and demand deposits with bank, whereas cash equivalent comprise of those short-term highly liquid investments which can be converted into known amount of cash and there is insignificant risk that the value will change. This is what is cash and cash equivalents. Now the reason we have spent a lot of time in understanding these two concepts is whenever there is a movement between cash items or cash and cash equivalent items, such movements are not classified or are not considered as cash flows. What does this mean? Let's say I have 1000 rupees with me. I deposited 500 rupees in the bank. Is this a cash inflow or is this a cash outflow? This is neither a cash inflow nor a cash outflow, right? When we are preparing cash flow statements, amount moving from one part to another within the cash bucket or within the cash equivalent bucket or between cash and cash equivalent bucket, such items are not considered as cash flow. When you deposit money into bank and you create a fixed deposit and that fixed deposit is only for 1 month, then it will not be considered as cash flow. But if the fixed deposit is for 5 years, then you may classify it as cash flow from investment activity. That is the reason why understanding of what cash is, what cash equivalent is very, very important. So in the balance sheet, whenever you see cash and cash equivalents, cash, balances with bank, short-term investments, highly liquid short-term investments, exclude that from your cash flow computation. And where will you show them? You will show them as either opening cash balance if it is the opening balance or as the closing cash and cash equivalent if it is the closing balance. Now that we have understood the meaning of cash and cash equivalents, let us understand how do we compute cash flow from operating activities. Now we have understood what are operating activities. These are the principal revenue generating activities. Now how do we compute cash flow from operating activities? There are broadly two methods. The first method is called the direct method and the second method is called the indirect method. We'll take a small example and understand how do we compute cash flows using the direct method. Now when we talk about cash flow from operating activity under the direct method, what we simply do is we summarize the cash book that we have. What do? We summarize the cash book that we have. Now what is the meaning of summarizing cash book that we have? See, what does the cash book tell you? What are the inflows? What are the outflows? Or what are the receipts? What are the payments? So just by summarizing the cash book, you can figure out what are the cash flow from the operating activities. Let's see how does it work. Let's say we have a cash book, or you can also call it a cash account. Now when I say cash account, it includes cash and also your bank balance, right? Now in the cash book, what all can you see? There will be first item you will find as to balance brought down. There are some items as balance brought down. Then on the receipt side or on the debit side, this side will capture all your receipts. On the receipt side, what will you get? Whenever you make sales, that item will be captured in this cash book. So you will obviously say to sales, you will capture some amount. Now when I say to sales, these are cash sales. Whenever a credit sale happens, will you record something in your cash book? The answer to that is no, because that will go in your sales book. Whenever the customer pays you the money, you will debit that to the cash account or to the cash book. So whenever you receive money from the customer, you will say to debtors, right? So this is how you will get money, or this is the inflow that you are considering. On the other hand, there could be many outflows. What could be the outflows on account of? Maybe you purchase something on cash. So you will say by purchases. You will put it on the payment side or on the credit side. Or you have paid your creditors. You will say by creditors. You have put the amount here. You purchase some fixed asset. You will say by fixed assets. You paid some salaries. You would say by salaries. So like this you can have many items of outflows, and at the end you will total up, the debit side, you will total up the credit side, and you will say by balance carried down some particular amount. Now from this statement, how can we prepare cash flow from operating activities using the direct method? Now as I said direct method is nothing but summarizing the cash book. It is not that you will have only one sale item or only one payment from debtor. You will have hundreds of such items. You will summarize everything and you will put it as cash from sales, or cash received from sale of goods, or cash received from customers. On the payment side, cash paid to suppliers, cash paid to employees towards salary. All those things will be summarized, and then you can present it as cash flow from operating activities using the direct method. In this cash book, what is this balance brought down? This balance brought down is nothing but your cash and cash equivalents. Will this go under cash flow from operating activity? The answer to that is no. This will be shown separately at the end. Then you have by balance carried down. Even this by balance carried down, it shows the closing balance. That is not your cash flow from operating activity. Is cash generated from sales, is that your operating activity cash flow? Yes, that is definitely a cash flow from operating activity. Money from debtors? Yes, these are my cash flow from operating activity. Purchases? Definitely yes. Payment to creditors? These are my cash outflows. Purchase of fixed asset. Is purchase of fixed asset a cash flow from operating activity? The answer to that is no. We have already understood something related to fixed asset or investments should be classified as cash flow from investment activity. So this part will not be shown under operating activity. And lastly, you have by salaries. They also form part of your cash flow from operating activities. Now, when you summarize this, you will be able to prepare cash flow from operating activities using the direct method. From the following information, calculate cash flow from operating activities. Summary of cash account for the year ended 31st March of year 1 is given to you. So the first item is on the debit side, to balance brought down 1 lakh. To balance brought down 1 lakh, what does it represent? It represents cash and cash equivalent. Then you have two cash sales 1,40,000. Is it a cash generated from operation? Is selling my principal revenue generating activity? The answer is yes, and hence the cash sales that I have made, the money that I have collected by making these sales is a cash inflow. Then they have to trade receivables. Now what does this mean, to trade receivables? Some of my debtors who had purchased goods earlier, they are making the payment now. Is it a cash inflow? Yes. Is it from operating activity? Is it a principal revenue generating activity? The answer to that is yes. So this also becomes my cash inflow. The other way to look at it is, if I look at my P&L account, if I see the revenue, whatever cash flows are associated with revenue is a cash flow from operating activity. So when customer pays me, it is a cash flow from operating activity. When I make cash sales, it is a cash flow from operating activity. Then to trade commission 50,000. Now what is this trade commission? Maybe I have purchased some goods from somebody and I have sold that goods to somebody else. I have received commission on that. Is it my operating activity? The answer to that is yes, it is absolutely my operating activity. Then to sale of investment 30,000. It is a cash inflow, but is it from operating activity? When I sell something out of my investments, something which is falling under investment category, that will be classified as cash flow from investment activity. Then to loan from bank 1 lakh. Loan means what? I have borrowed from bank. I am taking finance from bank. Is it cash flow from my operations? The answer to that is no. It is a cash flow from my financing activity. To interest and dividend 1,000. Now to interest and dividend on the debit side means I have received. It is an income. But is it an income related to operating activity? Generally, we get dividend on shares and shares are held as investment. Generally, interest we receive either on FDs or on debentures that we have invested. Again, those are generally held as investment. Unless information is given to you that those are short term, those are not held for investment, those are for trade purposes. Unless such information are given, income on account of interest, dividend and all these things, you will classify it under investing activity. If some customer pays you interest, then obviously we will say it is an operating cash flow. Then come to the credit side. By cash purchases 1,20,000. To make those sales, I would have purchased something, that is definitely my operating cash flow. By trade payables, I have paid money to creditors, operating cash flow. Office and selling expenses, these expenses are also incurred for my operations, so operating cash flow. By income tax 30,000. Now whenever we pay income tax could be paid for all the three heads, for operating, for investing, for financing. Sir, how can we pay income tax for financing activities? See, whenever we pay dividends, we have to pay dividend distribution tax. So even that is a tax paid for financing activity. Maybe you earned some money on investments, on that you will be paying tax. That is tax for investment activities. If nothing is mentioned, assume that income tax is purely for your operating activities. And one specific thing that you need to keep in mind is income tax must be presented separately. They have to be shown separately in the cash flow statement. Then by investment, you made some investment. Is it operating outflow? No, it is a investing outflow. By repayment of loan and then by interest on loan, both these activities are related to financing activity. And lastly, by balance carried down 1,04,000. This is my closing cash and cash equivalent. Now from this question, I have to figure out what are the operating activities and then I have to prepare a simple cash flow statement showing cash flow from operating activities. Now this is the extract of the cash flow statement. It's not the complete cash flow statement because we have been asked only about cash flow from operating activities, right? So the first item that we generally have is cash flow from operating activities, right? So now when you have to see cash flow from operating activities, if you look at the cash book or the cash account that has been given, which is in the summarized form, you can find out there are certain inflows, there are certain outflows. Let us write that. So you have cash received from sales or sale of goods or cash, cash sales, that is given as 1,40,000. Then you have cash received from debtors, that's given as 1,75,000. Then the next item you have is trade commission received, and the amount given to you is 50,000, right? Are any other cash inflows related to operating activities? No. So this is my total inflow. Then we have cash purchases. So there is an outflow given, cash purchases given as 1,20,000. Now whenever there is an outflow, keep it a standard practice to indicate it within brackets. Okay, whenever you are writing outflows, when you are preparing cash flow statements, make it a habit, all the outflows indicate it using brackets, so that when you are totaling up, you are not confused. Obviously another way is to write all inflows first, total them up, then write outflows, then total them up, and then show the difference. But for lengthier problems, that is not advisable. So right from the beginning, we will prepare in the way we will be doing the final solution, right? So always keep in mind to write the numbers in brackets. So first outflow is cash purchases, then we have payment to creditors. Payment to creditors, the amount given is 1,57,000, or you can also say payment to trade payables. Then you have office and selling expenses, office and selling expenses as 75,000. Then you have income tax. Now I want you to pause here. Whenever you have income tax, whenever you have information related to income tax, please keep in mind that income tax has to be disclosed separately. You have to present it separately. Don't mix it up with the other operating activities. So at this point, when you know that there are no further operating cash outflows, here you can put a sum up and find out what is the cash flow from operations, right? So we call it cash generated from operations. Cash generated from operations. Now what is the meaning of cash generated from operations? I have a business, there are some principal revenue generating activities, or there are certain revenue generating activities. I purchase goods, I sell goods. By doing all this, I have generated some cash. There were some inflows, there were some outflows. When I put them up in a single page, when I total them up, I get some cash flow, which I call it cash generated from operations. So how much is cash generated from operations? So let's total up. 140 plus 175 plus 50. So 365 is the inflow, minus 120 minus 157 minus 75. So you have 13,000 of cash which has been generated from operations. So you will write this as 13,000. Okay. So 13,000 of cash has been generated from my operations. I have not factored in tax yet. So for tax, then you will say less income tax, which is given as 30,000. Again, this is an outflow, indicate it in the bracket. So 13,000 minus 30,000, meaning to say you generated 13,000, now you have to pay still a tax of 30,000, which means there is a net cash outflow of 17,000. So mention that net cash used in operations. See, earlier we said cash generated, till the time it was positive, it is cash generated. We have got cash. Now when it becomes a negative, when we have paid more, which means we have cash, we have used net cash in the operations, we have spent more, or we have paid more than what we have received. The outflow is more than the inflow. So cash has been used in the operations. So what is the net cash used in the operations? The net cash used in the operation is 17,000. So all the negative amount, please make sure you write within brackets, right? This is a simple problem, and in fact in one of the CA final examinations, they had asked such kind of question for 6 marks, right? Sometimes you may get a bonus question like this where you just need to know how to present the information. What did we do? We understood what were the items under operating activities. Then we classified we noted the inflows, we noted the outflows, we disclosed the income tax separately, and we could find out what is the net cash flow from operations. Now we have understood how to find out cash flow from operating activities using the direct method. Now the direct method means you are summarizing the cash flow. You are showing the total cash receipts under each item or each category, and then you are also showing the total cash outflow, and then you arrive at the cash flow from operating activity. This is called the direct method because it is a simpler way of presenting the cash book itself. You are summarizing the cash book itself directly. So there are no adjustments as such. You take the cash book, you summarize all the information, and then you prepare the cash flow from operating activities. Now, sometimes you may not be given the cash book in the examination. You will be getting the P&L account and balance sheet, and still you will be expected to prepare cash flow using the direct method. Now, what does that mean? You have been given certain information of P&L and balance sheet. With that, you have to figure out what is the cash flow from debtors, what is the cash flow from sales, what is the cash paid to suppliers, what is the cash paid to employees. After you figure out all this, you have to prepare the cash flow statement. So let us take a small example and find out how do we handle such cases. So now let's say in a particular year, a company has made total sales of 10,000. Okay, so in the profit and loss account you will find by sales 10,000, and out of this cash sales is 6,000, credit sales is 4,000, right? So 6,000 plus 4,000 makes it 10,000. On the purchases you have two purchases. You have a purchases of 7,000, right? You have cash purchases of 2,000 and credit purchases of say balance 5,000. That makes it 7,000. This is the information given to you. Now, you know that this cash sales or the cash purchases I can directly pick and show it in my cash flow statement. How do I know what is the amount that I have collected from my debtors? How do I know what is the amount that I have paid to my creditors? For this, you will have to prepare simple ledger accounts. Once you prepare the ledger accounts, all those informations can be identified easily. Now, if you have to prepare ledger accounts, you need the opening balances, you need the closing balances. That information you will directly get in the balance sheet. So, let's say in the balance sheet you have information of debtors. Debtors in the year 1 was 1,000, now it is 1,200. What is the information you have? You have made credit sales of 4,000 and debtors opening balance is 1,000, closing balance is 1,200. We need to figure out how much cash has been collected from the debtors. If you prepare a simple ledger account, it becomes easy. So, let's prepare the debtors account. Now, when you prepare the debtors account, you know to balance brought down the amount is 1,000 because it is given that as at year 1 end the balance is 1,000 and we are talking about profit and loss account of year 2. Okay. So, to balance brought down 1,000. Then you made credit sales of 4,000. When you made credit sales, what will be the entry? Sundry debtors account debit or the respective debtors account debit to sales, right? So, this 4,000 will come and sit on the debit side of your debtors account. So, in debtors account you will say to sales 4,000, right? To sales 4,000. Now, in the balance sheet of year 2, if you look at the debtors balance, it is given as 1,200. This is nothing but the closing balance which will be shown on the credit side of your debtors account because it's a closing balance. The balancing figure will come on the credit side. So, we will write here by balance carried down 1,200. So, on the debit side, if you see on the debtors account, the total is 1,000 plus 4,000, total is 5,000. On the credit side, you have balance carried down as 1,200. There is a difference of 3,800. Now, what could have happened? What would be that amount that we have credited to the debtors account? We know it is 5,000 minus 1,200, that will be 3,800, and this item most probably would have been amount that the debtors have paid us. So, we would have said by bank or by cash 3,800, right? So, what is the cash inflow from operations? If you have to see here, you have cash sales of 6,000, cash collected from debtors 3800, which is nothing but your balancing figure. 6000 plus 3800, 9800 becomes your cash flow from sales, or you could present it separately. Cash collected from sales 6000, cash received from debtors 3800. So this is how you will have to find out the missing figures and prepare the cash flow statement. The same logic which you use in preparing accounts from incomplete records. You just have to find out what is the missing number, and with that you can easily say that this 3800 most probably would have been the cash collected. Let us change the example slightly. Let's say apart from purchases, I have a bad debt of 200. I have a bad debt of 200. Now, this bad debt of 200, where will I post it? I will again post it to the credit of my debtors account. So if you come to the debtors account, you'll have one more line item saying by bad debts, and what is the amount? The amount is 200. Now 5000 minus 1200 was 3800, minus 200 you have 3600. Now this becomes my cash flow, this becomes my cash collected from debtors. So like this you have to put out the information into a ledger account, and you will be easily able to find out what is the balancing figure, what is the cash inflow, what would have been the cash outflow. That can be easily computed. Now this logic is also important because when we do cash flow from investment or financing activities, it will be using this method only. Unless they have given directly what is the cash outflow or cash inflow, you will have to prepare a ledger account to find out what could have been the cash inflow or what could have been the cash outflow. Because for investing and financing activity related cash flows, we will prepare using the direct method only. I hope the logic is clear. Let's see how can we compute amount that has been paid to the creditors. Let's assume that we had trade payables of 500 and 600. Opening balance is 500, closing balance is 600. So you will prepare a trade payable or a creditor account, right? There you will put by balance brought down. By balance brought down. How much is the amount? 500. This is the credit side, this is the debit side. Then we have considered purchases on credit to be 5000. So on the credit side you will say by purchases 5000. What is the closing balance? To balance carried down, it's given as 600. So 5000 plus 500, 5500 minus the balance carried down of 6000, you get to bank, which is nothing but when you make the payment 4900. So this is how you can compute what is the cash paid to suppliers. Similarly, there could be any other ledger item. Just by preparing a simple ledger statement, you can figure out what is the cash collected, what is the cash paid. It is very simple. So what you have to do is, you have to link the information from profit and loss account and balance sheet and prepare this particular statement. Now if you carefully see this trade payable statement or trade payable ledger account, what do you see? You find that there was an opening balance of 500, closing balance is 600. The other logical way to understand this ledger is, assume for a moment entire 500 has been paid off. You have paid entire 500, which means from the opening balance there is nothing left. I am just saying assume. It may be possible that you did not pay something out of the opening balance, but for now assume everything out of the opening balance has been paid, and whatever you have purchased out of that 600 is not yet paid, which means I paid 500 of opening balance. Out of the purchases of 5000, I have not yet paid 600, which means I paid 4400. That means 4400 plus 500, 4900 is what I have paid to the creditors. Same way you can do an analysis of the debtor account as well, right? So whenever profit and loss account and balance sheet related information is given and you are expected to prepare cash flow under the direct method, then you will have to simply prepare the necessary ledger accounts and find out what is the amount received, what is the amount paid. Now we understood how to compute cash flow from operations using the direct method. First we saw a cash book or a cash account from where we extracted information. Then we spoke about how to plug in the missing figures and find out the cash flow. And we said there is another method for cash flow from operations, which is the indirect method. We'll park this indirect method aside for a while and we'll complete the discussion on cash flow from investing activities and cash flow from financing activities. How to identify, we have already discussed. How to compute these cash flow, the logic is pretty much the same as we have discussed for direct method under operating activities. So the way you computed cash flow from operating activities using the direct method, even financing activities and investing activities you will compute in the same manner, meaning to say you will find out what all were the cash inflows, what all are the cash outflows, and prepare a cash flow statement. So let's see a small question and understand how do we plug in the missing information when it comes to cash flow from financing activity. Following are the extracts of balance sheet of Ajay Limited. On the liability side, you have 15% debentures. As on 31st March of year 1, it is 5 lakhs. As on 31st March of year 2, it is 7 lakhs 50,000. And there is unpaid interest of 5,000. So we said 15% debentures, 5 lakhs and 7 lakhs 50,000, and unpaid interest of 5,000. And if you look at the asset side, you have discount on issue of debentures 90,000 and 1,15,000. So this is the extract of the balance sheet. You are required to present the cash flow from financing activities if discount on issue of debentures amounting to rupees 10,000 has been written off during the year. Now in the given question, what is the requirement? We are required to prepare cash flow from financing activities. Now what is the financing activities related information here? You have debentures, you had opening balance of debentures, you have closing balance of debentures, and as you can see, opening balance was 5 lakhs, closing balance is 7 lakh 50,000. There is an increase in value of debentures, which means the company would have issued debentures and collected money on account of those debentures. Now just by looking at this information, you may be tempted to make a guess that 2 lakh 50,000 should be the debentures that have been issued. But before you jump into the conclusion, you also have a look at what is the other information given. They have given you information about discount on issue of debentures. Even the balance of that has changed. So if you issue debentures at discount, if you are issuing debentures at discount, you will not get the entire face value. There is some amount which you are foregoing as discount, which you are not collecting at all. So what you will get from the debenture holders is a lesser amount. The company would not have got 2,50,000 in full. What we are concerned with is what is the cash flow, what is the cash component that has come inside or that has come into the company, and we are not concerned with what is the increase in face value. What we are concerned is what is the net cash that has come into the company. So for this we will need to prepare ledger accounts and figure out the missing numbers. So what we'll do is we'll prepare 15% debentures account, that is one account that we will prepare where they have opening balance of 5 lakhs. Now debenture is a liability, it will have a credit balance. So by balance brought down, this is on 1st of April of year 1. On 1st of April of year 1, you have by balance brought down 5 lakhs, this is given. Then as on 31st March of year 2, you have to balance carried down 7 lakhs 50,000. Now just because there is an increase in balance, just don't jump into the conclusion that 2,50,000 has been collected. We have to see what happened in the discount on issue of debentures account. So let's prepare another account. Discount on issue of debentures. What is the opening balance? As on 1/4 year 1, to balance brought down, the amount is 90,000. So 90,000 is the opening balance, and they have closing balance of 1,15,000. By balance carried down, this is on 31st of March of year 2. By balance carried down, you have 1,15,000. Now, discount opening balance was 90,000, closing balance is 1,15,000. We can see there is a net increase of 25,000, right? Because of this net increase of 25,000, 90,000 would have become 1,15,000. Does it mean that from this 2,50,000 increase of debentures, we gave 25,000 as discount? Again, that we cannot conclude immediately. Read the adjustment. It says, discount on issue of debentures amounting to 10,000 has been written off during the year. Meaning to say, whatever is the discount on debenture balance, it has been written off during the year, or it has been charged to the profit and loss account. Which means, from whatever is the discount on debenture issued, that is 90,000 plus whatever we would have given as discount during the current period, 10,000 has been transferred to the P&L. Now, if you transfer 10,000 to the P&L, you will debit the profit and loss account. The entry for that will be P&L account debit 10,000 to discount on issue of debentures 10,000. This is the entry you would have passed, meaning to say you would have credited the discount account by 10,000. So, on the credit side, by P&L account 10,000. Now, there is no extra information apart from this. So, you have 1,15,000 plus 10,000, total comes to 1,25,000. Opening balance was 90,000. So, there is an increase. There is an increase of what? 1,25,000 minus 90. There is an increase of 35,000. And how would have discount balance increased? How did amount come into discount account? How did the balance in the discount account increase? When we issued debentures, we would have given this discount. Because there is no further information, we can safely presume that this 35,000 has come from discount given on fresh issue of debentures. So, this is nothing but discount given on fresh issue of debentures. Now, let us see how will the entry be passed. What is the discount portion? Discount portion is 35,000. You will definitely debit the discount account with this. Then, what will you credit when you issue debentures? You will credit to 15% debentures account. What is the amount with which you will credit? Whatever is the increase in face value, that is what you would have credited with. So, from 5 lakhs, the balance face value increased to 7,50,000, which means we have issued 2,50,000 of debentures. So, face value of debentures issued is 2,50,000. So, in this particular entry, when you pass for issuing debentures, you will say to 15% debentures, 2,50,000. In other words, what is the balance amount received by you, or what is the amount that you would have collected in bank? You would say bank account is nothing but 2,50,000 minus 35,000. The company would have collected 2,15,000. So, 2,15,000. This would have been the entry for issue of debentures, right? Now, you will debit discount account by 35,000, which you have already done. You have captured the amount, and you will credit the 15% debentures account. So, what will be the entry here on whatever is the issue date? We do not know. To 15% debenture account 35,000, right? Come to debentures account. This 35,000 will be credited to debentures account. So, you will say by discount on issue of debentures. Discount on issue of debentures. What is the amount? 35,000. And we have already computed that amount collected through bank or amount collected in bank is 2,15,000. Let us again see the 15% debenture account and see if we get the same amount. So, on the debit side, you have a total of 7,50,000. On the credit side, you have total of 5 lakhs. So, 750 minus 5 is 250. 250 minus 35, you get 2,15,000, which is nothing but your balancing figure. What is this? This is amount collected by bank, 2,15,000. This number, the amount that you have collected in bank, this is relevant for your cash flow. Though the debentures balance has increased by 2,50,000, what is relevant for your cash flow is only 2,15,000 that you have actually collected. So what is the cash inflow from financing activity? When you are issuing these debentures, there is a cash inflow of 2,15,000. Now let's prepare cash flow from financing activity. See, it's an issue of debentures. We are borrowing monies for financing purpose. So we'll classify it as cash flow from financing activities. So cash flow from financing activities, right? What's the item here? We have proceeds from issue of debentures. Now, as I said already, what is the amount that the company collected by issuing these debentures? That is what is relevant. So here we have collected 2,15,000. This number of 2,15,000, that is what is relevant, not the increase from 50,000 to 7,50,000. This is not what is relevant. What is relevant is what is the amount the company has collected. So 2,15,000 is what is the cash collected. Are we done with the financing activities? If you carefully look at the question, it is a debenture issue. There was already an existing balance of debentures. So the company would have paid interest on debentures. The company would have paid interest on debentures. Now when we said whenever we pay interest on debentures, because debenture is related to financing activity, any cash outflow when we pay interest on debentures, that also will be classified as financing activity. I am repeating once again, because debenture, proceeds from debenture is a financing activity. Interest payment is also a outflow from financing activity. Now, in the question, we have not been given the exact dates of issue of the fresh debentures. Now, multiple assumptions are possible. We can say the debentures were issued on 1st of April. We can assume the debentures were issued on 31st of March of the current year. Either assumption is fine. What we will assume is debentures were issued on 1st April of the year, 1st April of the financial year. That means 5 lakhs debentures were outstanding as on last year and 250 were issued on 1st of April itself. Now, because they were issued on 1st of April itself, the interest is payable on the entire debentures. That is 15% interest will be paid on 7,50,000. So, interest payable is equal to, what is the face value of debentures? 7,50,000 multiplied by 15%. How much is that? 750 into 15%, you get 1,12,500. So this is equal to 1,12,500. Otherwise, you assume debentures were issued on the last day of the current year and no interest was payable. In the second case, this is the first case. If issued on 1/4 of year 1, otherwise if issued on last day of the financial year, the interest would have been only what is payable on 5 lakhs into 15%, that will be 75,000. Either assumption is perfectly fine. Now, let's say we take the first assumption, 1,12,500. Is this the interest paid or is this the interest payable? That is the question you need to ask. This 1,12,500 is the interest payable. We might not have paid the entire amount. If you look at the question, there is an unpaid interest of 5,000. What does that mean? Though I was supposed to pay 1,12,500, I did not pay 5,000. Means that 5,000 is still payable. In effect, I would have paid this minus 5,000. This is what is paid. This is what is paid. 1,12,500 is the total interest expense for the year. This is what you will charge to P&L. But how much of that is paid? 1,12,500 minus 5,000, which is 1,07,500. So, interest paid is 1,07,500. This is what is paid. In cash flow, you will only consider what is the cash outflow, not on accrual basis. Just think this is a cash based accounting. We are only considering cash item, cash related items, cash flow means there is an inflow or outflow of cash, right? So the second item here is interest paid on debentures, 1,07,500. So now you collected 2,15,000 by issuing debentures. On that you have paid 1,07,500 of interest. Mind you friends, this 1,07,500 is a cash outflow. You will denote it within the brackets to indicate that it is an outflow. Inflow minus outflow, you will get net cash flow from financing activity. So 0 minus 0, 0, 0, 5, 14 minus 7 is 7, and 40 minus 7 is 7, 20 minus 10 is 10. So 1,07,500 is what is the cash flow from financing activity. So just write cash flow from financing activity. Cash flow from financing activity 1,07,500.